I think we are now in a new realm for PayPal. They have opened the door for activist, aggressive investors, huge institutions that say, hey, you know what? We want to change it up. We want to completely replace management, replace the board of directors. I think you're going to see a lot of change with PayPal. I do expect some sort of activist outside investor to get involved. Let's discuss why in this video. My name is Daniel. You're watching Unrivaled Investing. And let me take a step back first, because it is important to understand some context. I've done a couple of videos on PayPal. I did one in October of last year asking if it was on sale. My conclusion at the time was that it was relatively cheap based on its free cash flow, but there was particularly one key aspect that prevented me from buying it relative to my checklist. And I talk about my checklist in this video. So we're going to cover that in just a second, why I didn't pull the trigger despite the fact that it's cheap. And so everyone is going to have their own different investment journey. Since then, PayPal stock has continued to plummet. Yesterday, just falling, I think around 20%, down again today. Over the last 5 years, down like 90%. This is red meat. This is blood in the water for the sharks, the activist investors. So why does it continue to lose such dramatic amounts of, market value? Well, just yesterday they announced, oh yeah, by the way, they said, hey, we're delivering solid performance, but you know what? Our execution has not been where it needs to be, particularly in branded checkout. That's their key high margin asset, the PayPal button. And so as of today, the board's appointment of Enrique Lores as the PayPal next president and CEO. So i.e., we just canned Alex Chriss, who they just brought in August of 2023. So this alone, in my opinion, is a red light, because any long-term investor knows it takes a few years for things to play out. And arguably, there were signs that Alex Chriss was slowly righting the ship. I'm not sure that I would say definitively that he was. I'm not so in the weeds. I'm not, inside PayPal as a company. But I would say, look, if you're going to make a bet on a jockey, you'd arguably need to give 4 or 5 years, in my opinion, because these types of companies, you're talking about huge organizations. It takes time to move a ship in a different direction. This is not like a race car where you just, do a flip, handling a hairpin turn very quickly, and all of a sudden you're going in a 180 degrees. It's a big company, $40 billion company ballpark. So it requires time. So that is an aspect. So when you see the board of directors, replace the CEO, it's like, okay, maybe they're not being patient enough. Maybe the board of directors is not competent. And I'd argue it's the second. The board of directors is not competent, because here it is. You have one of the former leaders of PayPal, David Marcus, and he wrote this long Twitter post effectively saying, yeah, they keep putting in leadership that really doesn't have any payments experience. And he's talking about Alex previously was into it, and now, they're bringing Enrique Lores, and he's a former HP CEO, Hewlett Packard, neither of which are payments executives. And so any further, he's making the point that arguably it was really Dan Schulman, that CEO. I called that out. If you go back over the prior years, I was like, Dan Schulman's not a great CEO in my opinion, and I thought he was leading the company in the wrong direction. That was one of the key aspects on why I didn't pull the shares. So then I see, Alex Chriss has a sizable stake in the company, new CEO. I go, okay, maybe this is interesting, a couple $1 million. And so then, I see he's getting replaced quickly. I see the former, David Marcus, formerly running the company, were one of the top dogs at PayPal, effectively saying, yeah, it's been mismanaged for years because they keep focusing on short-term to medium-term guidance type of things versus thinking about the long-term business and creating, something that's unrivaled. And that is the heart of the issue here with PayPal. We're going to keep getting back to that. Looking at their results, it's not absolutely like the house is on fire. Maybe a little bit. How about this? The house is on fire in the sense that they're losing share. And that is always a red flag to me as an investor. When you go, oh yeah, there's these players over here that are absolutely crushing it and growing 20%, and you're only growing 1%. 2%, 4%. That's not enough. It means customers are actively saying, yeah, there's a better value proposition going with someone else. So that is sort of the fire in the room, but I wouldn't say the whole house is on fire. It's not like melting away. You're not expecting the whole thing to fall apart like right overnight. And, the truth is this is still a business that's growing. Revenue grew 4%. Once again, they're losing share relative to the companies like Stripe that are aggressively taking share, growing closer to 20% a year. And for the year, once again, growing closer to 4%. So, they are clearly losing share, which is that red flag. And then, by the way, their guidance for this year is also pretty darn bad, where they're saying, yeah, we're expecting a decline in adjusted earnings this year. Low single digit decline, maybe slightly positive. And they're also pulling their multi-year growth outlook. That was from the investor day. Once again, that's the prior CEO. So I guess I can understand that. But I'm looking at all this drama. You had Dan Schulman, then you're a board of directors, and Dan Schulman made all these acquisitions. And when he made those acquisitions, I was like, this doesn't make any sense. This doesn't enhance the core of the business. Honey was the one that sort of jumped out to me. It's like, what are they doing? They're just wasting their cash flow on this. And so, but I'm sure he'll be remembered as like, hey, he ran PayPal, huzzah, fancy executive. I mean, you need to look at these things and say, like, do you actually create value, or are you shrinking your moat? Are you losing to competitors over time? And that previous strategy, I mean, he got out, he was smart. Now it's a huge buyback, make all these acquisitions, and then, I'm getting out of here. What a disaster. And so then they bring another, and then you have this board of directors that don't even, wait I'd argue long enough to see a turnaround. Once again, I don't own a stake in PayPal. I'm just calling it as I see it. So I'm looking at the setup with the stock completely, in the dumpster, down like 90% over the last 5 years. Board of directors that arguably don't know what they're doing, don't have alignment. I would love to see each of these board of directors buy $1 million worth of stock before I start trusting their judgment. I have zero faith that they will put in the right people at this point, in my opinion. And so I think this is such blood in the water for an activist investor to go like, oh my gosh, look at this mismanagement. Look at this board of directors lineup, that doesn't own huge stakes in the company. We could buy $1 billion and probably move this. I think that's what they're starting to think. Like, how much would it take for us to move this, to maybe even get some seats? How much would it take for us to get control of this company? So I think you're definitely going to start having those conversations, because they're looking at it, why would the activist investors, potentially look at it be other than the fact that it's mismanaged? Well, they're going to look at the free cash flow. It's still generating, at least despite their negative guidance saying, yeah, our core earnings is expected to decline because we need to invest in this business. They're saying, yeah, it's still going to be $6 billion plus in adjusted cash flows, of which they're going to buy back, use all that free cash flow to buy back stock. Now that might be enough, you'd think, to keep sort of the activist sharks from swimming in, because they're like, well, how much more cash could you return if all that's going to share repurchases? I think the activist investors get involved because they're looking at this and they're thinking around $40 per share. This is a $38 billion market cap. They are aggressively reducing the share count, down 8-9%. But this $6 billion in free cash flow relative to this market cap is around 6 times. And that is just so compelling. Looking at these different assets, maybe they can get sold, maybe they can get broken apart. And so I think the activist investors, I mean, they're looking at this now, and it wouldn't surprise me if one of these, or maybe some other, is going to say, you know what, this is worthwhile for us to consider, because we could effectively put out a giant nastygram saying, look how poorly this has been mismanaged by this board of directors. Look how little skin in the game this board of directors have. Why don't we just go, spend $1 billion? Why don't we, one of these funds spend $2 billion, $4 billion? And now you have real ownership. And what you could do is say, yeah, we want to take over. We want to run the company. We want to put on our own management. We don't trust you. So I think that sort of fight could get underway. And then you have the dynamics of, well, 6 times, 6 times, why not go to 10 times? And so that wouldn't surprise me if you do have that sort of valuation reset. And going from 6 to 10 times, that's a huge win, especially for one of those sort of funds that are like, yeah, I might play around, and maybe they work as a wolf pack. You get one and you're working together. Would not surprise me at all if you see that dynamic in the near future. I mean, just think about the risk reward dynamic for them. If the business stays flat, if this arguably incompetent board of directors can manage to keep the business flat while their competitors are growing 10 to 20% a year, just keep the business flat. And 6 times means you're retiring, it's a 16% cash flow yield to shareholders. Now, yes, there's some stock-based compensation. So let's say you're reducing, the shares to the tune of 12% a year. So these, one of these activist investors go, okay, the downside is that we're making 10% plus a year and there's no multiple expansion and the business just stays flat. And the upside is we reset it, we put someone in our place, we put someone in management place, and then it resets to a 12 times multiple. It doubles. And then maybe we actually prove that you can get much better margins over time, or you're actually able to reinvigorate the growth in this company. And that reinvigorating the growth, that is going to be the difference between whether or not you see this up or down, let's say 50% in the next year, or potentially, let's say 300% over the next few years. The ability to reinvigorate growth is going to be critical if you're playing for the multi-baggers. That's personally how I think about it. But as I called out in my prior video on them, they still face huge challenges. Apple Pay, Shop Pay, Stripe. So you have the embedded payments, you have competitors, you have the, OS wallets. These are all taking share from PayPal. And that is just super tough. So what do I think about PayPal from here? First of all, none of this is financial advice. Also, quick plug, Henry W., a premium subscriber, he wrote, I want you to know, as long as you continue the unrivaled service, I will be a lifetime subscriber. Similarly, Mohammed D. wrote, I have been a member of Unrivaled Investing for over a year now, and I'll say that to me, although the positions you have covered have more than covered the membership, so the positions talked about, he decided to tag along, and they've more than covered the subscription costs. He's saying, my return on investment is what I've learned through your weekly letters, because we talk about a lot of things. We talk about the concepts. This past week, I was actually talking about, I think, a significant change in the macro environment that I think every investor should be aware of and reflect on. And so if you're looking for compelling ideas, come check out Unrivaled Investing. I turned to Flash in my last video, and it effectively said, yeah, there's a lot of upside potential. Even in the low case, it said there was 25% upside. But now, adjusting for this change in management, weaker results, it's saying, yeah, maybe there's a little bit more headwind from here. Maybe it keeps, dropping. Maybe it's down about 30% downside if things really, keep getting worse. Fundamentals keep contracting and, keep losing market share, expecting years, let's say, of earnings declines versus just 1 year. So the terminal decline situation is, you might lose money over the next 5 years. Another situation is, there's a fintech renaissance. And that's what I was talking about. The multi-bagger situation is you're able to do some sort of upset that you start holding share and then winning share. Now in the report, and look, Flash is AI, it's free to use. We're trying to leverage the most cutting edge AI models available. So that way, you can see what's available and you can look up any company in the world. We're also building out portfolio features so that way it can analyze your portfolio. There's, weekly best ideas. There's a lot going on there. I'm one of the co-founders of Flash, and partly it's just because I think this AI stuff it's revolutionary, and I like to watch it. I like to see, like, now there's a free video on any company that you're interested in. So I mean, it's very incredible to see what's going on in this revolution. And here's part of the report from PayPal. And, it effectively calls out, look, management was making the steps to try to turn around their branded checkout. And this included the integration of biometric authentication. And that early indications suggested that this was causing a better lift in conversion. So people were using the branded checkout more often if you integrate that biometric authentication, but it was sort of early days. And unfortunately, the rise of, let's say, Apple Pay, Google Wallet, and controlling the iPhone hardware is ultimately just making it tougher for them. They're making it so that the button appears redundant for the consumer. So that is a very real headwind that they're going to be facing in the years ahead. So I'm not sure, how do you undo this risk, this Apple Pay risk, to reaccelerate the business? And I've talked about repeatedly on this channel my checklist. You can find turnarounds, you can find cheap stocks. One of my favorite investors right now is aggressively buying shares in an apparel company. I don't like apparel companies, so I'm not going to tag along. And he's effectively saying, hey, the founder's there, and he thinks he's going to, the company's going to turn around, and he's making a turnaround bet. And this guy is one of the greatest investors on earth. He's done it many times before. He's made several successful turnaround bets, some very famous failures. But every investor has to figure out what's right for them. This very successful investor, he loves turnarounds and super deep value situations. Me personally, this is what I'm looking for, this checklist, because I want management alignment. I want obvious growth. I want compelling valuation. I want limited blow-up risks. And when I look at PayPal today, it doesn't fit because that management alignment part is so critical and it's missing. I'd say when you just swap out a CEO every 2 years because your plans are taking longer than you expected, you have a problem. And arguably, there's also a competence problem where you don't fully understand what do you actually need to do to fix this. And then you have the prior, David Marcus coming in, tweeting from the side saying, yeah, this sort of hurts my heart because he cared so much about building PayPal in the early days, back when it was part of eBay. And saying, look, there was a path here where this could have crushed it, but you ultimately have folks that are mismanaging it or more focused on the financial incentives. And so I look at this in the management alignment. This is just a critical part where they just keep getting it wrong. And then when you look at the fact that you don't have you're losing share, that is another X as opposed to a check mark for obvious growth. I love it when companies can say, here's why we're, winning share. And this is the part that I think a lot of folks are going to have trouble with, even if an activist investor gets involved, which is that without true ownership, without that management alignment, without that buy-in, you're not going to have the discipline, the power, the internal, you can't push those chips on the table to make the hard decisions that can reclaim market share. You can get an activist involved. I think an activist getting involved is way over 50%, in my opinion. We'll see what happens. So I really do think that's going to happen just because this is so juicy. And it would, you think about the headlines, wipe out the prior board, put in someone that actually knows something about payments. Smells like a layup, once again, for activists to get involved. But this is the hard part. Are you looking at an activist that's going to, let's say, book a valuation multiple change from 6 times to 10 times, say, done deal, hurrah, or 6 times to 12 times, hoorah, we just crushed it. We just got double our money. We're out. Mic drop. You're going to have that, or are you going to have the management that says, there's a reason why we're losing share. And the reason why we're losing share is not just because of the Apple Wallet. It's because some of these competitors, they're just better than us and they offer better pricing. And there's a reason why these competitors are winning share. And that's what I mean by lacking the discipline, because you don't have the ownership stake. So you might actually have to take the company private, I'd argue, in order to make some of these tough decisions. Because you might need to say, you know what? That free cash flow of $6 billion, I mean, it would require like an Elon Musk type of action, in my opinion, to get that sort of 400% upside scenario where they go, I'm going to blow up this company. I don't care if free cash flow goes from $6 billion to $3 billion. because I'm going to take that reinvestment and now I'm going to charge less than these players that thought they could win. You need that sort of disruption. Now, Wall Street would like completely yak over that because they'd be like, oh my gosh, this isn't what I signed up for. I didn't sign up for you cutting free cash flow overnight. But I think you're going to need to have that sort of bold action where someone's going to say, you know what, this requires a complete reset. Complete board of directors wipeout, complete reassessment of what your new pricing structure can be. I can tell you firsthand, I'm a merchant that has used PayPal in the past, uses other payment processors. I can tell you from experience, PayPal charges more. Their service is slower and crappier. Full stop. From a merchant perspective, it is not as good as these other competitors. So I think that needs to be there's a huge deep reset, and that reset will cause investors to panic if they're short-term oriented. So it really depends. This is part of the reason why I don't own the shares, even though I think it could do quite well from here. Are you going to get the activist that's playing for, let's say, 50 to 100%, or are you getting an activist that says, look, I think this could be, this can be a true turnaround. This could be a 500% type of upside scenario if you truly reset the company and set it on a growth trajectory where we are taking share. And taking share doesn't just need to be on a pricing initiative. They need to be at pricing at or lower, just based on the fact of how crappy the service has become, I'd argue. That's you need that level of reset. And that type of direct pricing reset, that's going to hurt everyone in the space. It's going to be painful. No one's going to want you to do it except for someone crazy enough and bold enough to say, hey, I have this vision that PayPal will once again be a growing company and could be number one. And until you have that, you're just going to have the volatility, 50% upside, 100%, maybe 30% downside. So I personally don't like the lack of alignment. But if there was an aligned CEO that's like, yeah, I'm crazy enough. I just bought, I just took my life savings, someone puts $10 million in it. They're all in. Then it's interesting for me personally, because the guy's saying, and this is how we're going to do it. And we're going to cut free cash flow from $6 billion to $3 billion. People would not like that. $6 billion, maybe $6 billion to $1 billion. I mean, that's the type of thing that Elon Musk did with Twitter, where he's like, look, we're going to blow up this business, and then we're just going to cover our debt expense, and then we're going to figure out how to grow it from here. Now, who knows how Twitter ultimately will play out, but I think that's the type of radical policies that you're going to need to see. So I'm very curious which activist. I would say that's my framework. I'm curious which activist you read about in the newspaper one of these days. I hope this video talking about PayPal has been helpful for you. Thanks so much for watching. If you enjoy this content, I do appreciate you hitting that thumbs up, hit that subscribe button. Thanks so much.